Have you ever felt just utterly swamped by the sheer number of financial decisions you're expected to make today? I mean, from just trying to decipher complex student loan terms or watching inflation silently chip away at your savings, maybe even navigating the bewildering world of investment options. And yeah, dodging those increasingly sophisticated digital scams. It really feels like the financial ground beneath us is constantly shifting, leaving so many of us scrambling just to keep pace. Welcome to the Deep Dive. This is where we take a stack of important sources and we extract the most vital insights and surprising facts just for you. We cut through all the noise to get straight to what truly matters. Today, we're doing a deep dive into something that's becoming absolutely foundational for well-being: financial literacy and financial education. Our primary source for this is a really comprehensive, I think incredibly insightful review article. It was published just this April 2024 by two leading experts in the field, Tim Kaiser and Anna Maria Lusardi. Now, this isn't just a single study. This paper pulls together insights from a rapidly growing field. It synthesizes findings from over 7,000 academic publications. So think of it as your express lane to understanding this absolutely crucial area without having to wade through thousands of papers yourself. Our mission today is to truly unpack what financial literacy even means. We want to understand its current state globally, explore how it profoundly impacts your financial behaviors and outcomes. And then, get to the burning question that I think is on everyone's mind. Can financial education actually work? And if it does, what kind of programs are most effective for you? Get ready for some truly illuminating and hopefully very practical insights that could directly impact your financial future. So when you hear that phrase financial literacy, what exactly pops into your head? Is it some abstract concept about high-stakes investing, or is it something more fundamental, something more woven into the fabric of everyday life? The paper we're diving into defines it in a very specific and I think incredibly helpful way.
That's a perfect place to start, actually, because the definition really does set the stage for everything else we'll talk about. The paper defines financial literacy as domain-specific human capital related to personal finance.
Okay, domain-specific human capital. Sounds a bit academic.
It does, yeah, but think of it this way. Just like you build human capital through, say, a college degree, gaining specific skills for a particular job, financial literacy is about building specific skills and understanding just for managing your personal money. It's practical, applied knowledge. And the paper really emphasizes why this type of capital has become so critical in our modern world.
Right. Why now more than ever?
Well, for one, we're seeing an ever-increasing complexity in the financial landscape. Globalization means your finances are now exposed to products and markets far beyond, your local borders. And the sheer array of financial products available today, from intricate mortgage options to diverse insurance policies, complex retirement plans, understanding the basic concepts is utterly non-negotiable now.
It's not just a simple savings account anymore.
Exactly. It's like navigating a dense, constantly evolving forest of options. And then there's something very current, very tangible: inflation.
We're all feeling that.
Right. Rising inflation directly underscores the importance of financial literacy. When prices are consistently going up, understanding how that erodes your purchasing power and knowing how to potentially protect your assets through smart financial decisions in these complex markets, well, that becomes absolutely vital. Without that knowledge, your hard-earned savings can effectively shrink over time. It can feel like you're running just to stand still.
Yeah, definitely. What else?
Then there are the new technologies. Think about digital transactions, online banking, the rapid emergence of crypto assets. They've totally transformed our financial lives.
For better and for worse, maybe.
Well, exactly. They offer incredible convenience, new opportunities, sure, but they also introduce novel risks. Financial literacy in this context is critical. It's about scam avoidance. It's about wise money management in a landscape that's evolving almost daily. You really need to understand the underlying principles to protect yourself in this sort of digital frontier.
Makes sense.
Another significant shift that's placed more burden on individuals is the move away from traditional pension schemes in many places.
The shift to things like 401ks here in the U.S.
Precisely. We've seen a clear trend towards these individualized retirement accounts. This places additional, quite significant responsibility directly on your shoulders to secure your own financial future. You're often managing your own investment choices, your contributions. You're bearing the risk and responsibility yourself now, not your employer quite so much.
That's a huge shift.
It is, and specifically within the U.S. context, two areas really stand out that highlight this need: First, the sharp rise in student loan debt over the last decade or so. It just emphasizes the urgent need for young people to really comprehend loan terms, interest rates, repayment options before they commit.
Yeah, understand what you're signing up for.
Exactly. And second, increasing healthcare costs. This just reinforces the need for sound financial planning, a really comprehensive understanding of insurance policies. These aren't minor expenses, right?
Yeah.
They're potentially life-altering financial commitments that absolutely demand an informed approach.
So at its core, this is really about empowering individuals, empowering you to make informed decisions and ultimately improve your financial well-being. It sounds like it's definitely not just a niche topic for finance professionals anymore. It feels foundational for everyday life for basically everyone.
Absolutely. It's truly foundational. And that's reflected in the academic field itself. The paper notes this explosion of research. We're talking over 7,000 publications in peer-reviewed academic journals in just the last 15 years.
Wow, 7,000.
Yeah, it's huge. In 2022 alone, there were over 1,300 publications, attracting tens of thousands of citations. It's even become an established field of study in academic economics, with its own Journal of Economic Literature code G53, signifying its recognized importance and distinct body of knowledge.
So the experts are definitely paying attention. Hashtag tag BD.
Uh-huh.
How do we actually measure financial literacy? The big three explained. Okay, if financial literacy is so important, so foundational, how do researchers actually measure it? I mean, how do they get a handle on something potentially so broad and apply it across thousands, maybe millions of people in different countries? It sounds almost impossible, right? Trying to gauge someone's entire financial understanding with just a few sentences. But apparently, researchers have found a remarkably effective way to do just that, something called the big three.
That's a perfect way to frame it. And yes, much of the empirical evidence we have about financial literacy levels around the world relies heavily on what's become known as the Big Three. These are just three short, quite informative questions designed to measure understanding of very basic, absolute fundamental financial concepts.
Okay, just three. What are they?
So the first question assesses understanding of compound interest. Your ability to grasp how interest accumulates not just on the initial principal, but also on the previously earned interest.
Right, the snowball effect.
Exactly. It's the magic behind long-term wealth growth, or, if you're on the debt side, the insidious nature of long-term debt. The second is inflation. Just comprehending how rising prices erode the purchasing power of your money over time. $1 today isn't worth $1 tomorrow.
Very relevant right now.
Very. And the third is risk diversification. Understanding that basic principle of spreading investments across different assets to reduce overall risk. Essentially, the old adage, don't put all your eggs in one basket.
Okay, compound interest, inflation, risk diversification. But why just those three, it seems? Maybe too simple.
It's a good question, and the rationale is quite thoughtful and effective. They were designed first for minimal response burden.
Meaning they're quick to ask.
Exactly. Quick and easy to administer in large surveys, which makes them highly practical for researchers. They also offer adequate reliability and discrimination, meaning they're consistent measures and they genuinely pick up on who knows what, regardless of where they are in the world. And crucially, they were designed to embody broad rather than context-specific concepts. This makes them universally applicable across numerous countries and cultures, not just tied to one specific financial system.
So they travel well, essentially.
They do. And recent work, which the paper cites, has confirmed their sound psychometric properties. That's just jargon for saying they've been rigorously tested to ensure they truly measure what they claim to measure. And maybe most impressively, they have predictive validity, meaning they can actually predict how you'll behave with your money in the real world. Your answers to these three simple questions have been shown to correlate with actual financial outcomes.
That's fascinating. Just three questions can capture so much and even predict behavior. It almost sounds too simple, like you said, but the research clearly backs up their power.
Exactly. Now, don't get me wrong, there are certainly more extensive measures of financial literacy out there, and many studies do use them for deeper dives. But the simplicity and the proven effectiveness of the Big Three truly catalyzed the rapid development of this field of study. They provided a consistent, broadly allocable metric for researchers globally. It really became a foundational tool.
Got it. A simple, effective starting point. So what does this all mean for you, the listener? Once they measure it using these reliable tools like the Big Three, what did the studies actually tell us about the general level of financial literacy in the population, both here in the U.S. and maybe globally? Because the findings here are, they're quite a wake-up call.
They really are. The empirical evidence is quite sobering, actually. It consistently shows that financial literacy cannot be taken for granted. And this isn't just true in developing economies. Even in countries with highly developed financial markets, say, the G7 nations, the overall picture is concerning.
How concerning?
Across most countries surveyed, overall, only half of the population, or even less, is knowledgeable about the basic concepts covered in the Big Three.
Half, or even less.
Yeah, that's a fundamental literacy gap for half the world's adult population, potentially. It's not just a minor issue, it suggests a substantial portion of adults are navigating these increasingly complex financial decisions with only a very basic grasp of the fundamental principles.
Wow. That's a powerful and honestly a surprising fact. It's not just a few people struggling, it's literally half the population. It really underscores the urgency of this topic.
It absolutely does. And when you dig deeper, you see some very consistent demographic patterns emerging. These patterns often replicated across many countries, and they're further confirmed by that recent 2021 National Financial Capability Study, the NFCS, of over 25,000 U.S. adults, which the paper uses extensively.
Okay, so who tends to score higher or lower? What are these patterns?
Well, first, and perhaps the most striking, is the gender gap. The paper calls this one of the most striking empirical regularities in the entire literature. Women consistently perform worse than men on financial literacy assessments.
Consistently. And everywhere.
Pretty much. This isn't just a U.S. phenomenon, it's replicated on every continent. One global survey found this gap in 135 of the 144 countries studied. What's more, the gap remains substantial even after researchers control for differences in education levels and income. And it's present even among 15-year-old students, so it starts early.
That's deeply ingrained then. Any idea why?
It's complex, and research is ongoing. But one interesting contributing factor researchers have explored is women's much higher propensity to answer "I do not know," particularly when faced with complex questions. This suggests that maybe a confidence element or perhaps a higher bar for certainty before venturing an answer might play a role rather than purely a knowledge deficit. It's a really fascinating area needing more research.
Okay, so gender is a big one. What else?
Next, age and financial literacy. We typically see an inverse U-shaped relationship,
Really?
meaning financial literacy generally increases with age, peaks in middle age, roughly in your 40s or 50s, and then tends to decrease somewhat in older ages. This makes intuitive sense if you think of financial literacy as a form of human capital, right? Something you acquire over your lifetime through experience and learning, but which might also depreciate or decline as cognitive abilities perhaps shift later in life.
You build it up, then maybe it fades a bit. Makes sense.
Then there's cognitive ability and education. Naturally, you'd expect domain-specific human capital, like financial literacy, to be correlated with broader human capital and educational attainment. And the data from the U.S. consistently shows that financial literacy is especially low for those without a college degree.
But is it just education or is something else driving both?
That's a key point. While education and financial literacy are correlated, both could be influenced by underlying general cognitive ability. People who are maybe naturally more analytical might pursue more education and find it easier to grasp financial concepts. However, the paper notes that even after accounting for cognitive ability, much of the heterogeneity in financial literacy remains unexplained, which is a really key insight. It suggests there's more to it than just raw intelligence or years spent in school. Other factors are clearly at play.
Interesting. So experience, maybe confidence, other things.
Potentially, yes. And the latest NFCS 2021 data, which is presented really clearly in Figure 1 of the paper, broadly reinforces all these patterns. It shows that gender gap favoring men by about 0.3 standard deviation units. Now, to put that into perspective, imagine a bell curve of financial knowledge. A 0.3 standard deviation difference means the average woman is scoring significantly lower than the average man. It's a substantial and consistent gap.
That is significant.
Yeah. Minorities score about 0.19 standard deviation units lower than whites. Those without a college degree score about 0.23 units lower than those with a college education. Some other interesting correlations. Married individuals sometimes score slightly lower, retirees slightly higher, and less risk-averse individuals actually score higher on financial literacy, which is interesting. And as expected, there's a strong positive relationship with both age up to that peak and income.
Okay, so clear demographic patterns. But you mentioned intersectionality.
Yes, exactly. Intersectionality. Where the story gets nuanced, this is particularly important with such large data sets like the NFCS. It allowed researchers to explore not just individual characteristics, but how these demographic variables combine and interact. This is absolutely crucial because it shows us that the experience of financial literacy isn't uniform across groups. It's not just being female or being a minority. It's about how these characteristics intersect and sometimes compound.
Right. This is where it really gets compelling, I think. It's not simply about being female or a minority or having less education in isolation, but how those factors interact in these complex ways.
Okay.
So what did they find when they looked at these combined effects? How did these layers of identity influence financial literacy?
Well, some interesting nuances emerge. For example, they didn't see significantly varying patterns for income and financial literacy across genders. However, for minority groups and individuals without a college degree, the disparities in financial literacy actually become less marked at higher income levels, specifically above $100,000 per year.
So higher income can buffer some of those gaps.
It suggests that, yes, achieving a higher income seems to partially mitigate some of those disparities in financial literacy that are seen at lower income levels for these specific groups. It acts as a powerful moderating effect.
Interesting. What about age interactions?
In terms of age, the gender gap in financial literacy actually widens with age. So as women get older, that gap relative to men tends to increase, unfortunately. Conversely, the gap between white individuals and minorities is narrower for working-age adults compared to other age groups. That's maybe a more positive sign for the current workforce. And the difference in financial literacy between those with and without a college degree, that gap is most noticeable among older people, specifically those aged 65 and above.
Why might that be?
Well, it could imply that the lack of formal education becomes a more significant predictor of financial literacy as one ages, perhaps as access to new learning opportunities dwindles, or maybe the practical exposure that comes with working life diminishes.
Okay. And any other key interactions?
Perhaps the most striking one highlighted is a moderately strong interaction between gender and lack of college education. This suggests that women without a college degree experience a more significant gender gap in financial literacy than women with a college degree, or compared to men without a college degree.
So lacking a college education hits women harder in terms of the literacy gap.
It seems to amplify the pre-existing gender gap, yes, creating a sort of compounding disadvantage.
So what does this all mean for you, the listener? It really means understanding financial literacy isn't a simple one-dimensional picture where you just tick a box based on one characteristic. It's a complex interplay of various factors: gender, age, education, income, race, all shaping your specific knowledge and experiences. This level of detail is exactly why we do these deep dives. It shows that any effective policy interventions or educational programs really need to be highly nuanced and targeted to truly make a difference for different groups. #tag2. Does financial literacy actually affect financial behavior? Unpacking this, so what?
Okay, we've established that financial literacy levels vary significantly across the population, often along these predictable, sometimes intersecting demographic lines. But does having or lacking this financial literacy actually do anything for you in a tangible way? I mean, does it genuinely make you better or worse off financially in the real world? This is really the so what question, isn't it? Where the rubber meets the road.
It absolutely is the so what question. And as the paper highlights, it's actually notoriously difficult to answer definitively just from observing data. The main concern, the big challenge, is that correlation doesn't automatically equal causation.
Right, the classic statistics warning.
Exactly. For instance, if we observe that financially literate people tend to save more, is it because literacy causes them to save more? Or could it be that other unobserved factors, things like maybe an inherent cognitive ability or a natural inclination to be disciplined about money, cause both higher literacy and higher saving? It's that classic chicken and egg problem, and it's really hard to disentangle just by looking at correlations.
So what are the specific challenges researchers face here?
The paper pinpoints two key challenges. First, something called endogeneity. This basically means there might be these unobserved variables, things like personal motivation, maybe inherent confidence in financial matters, or that underlying general cognitive ability we mentioned earlier that influence both a person's financial literacy and their financial behaviors. If these hidden factors are driving both, then a simple correlation between literacy and behavior could be totally misleading. It might appear causal when it's really not.
Okay, so hidden factors. What's the second challenge?
The second is the issue of reverse causality. It could also be that actively engaging in a financial behavior, say, participating in the stock market, or diligently saving for retirement, actually improves a person's financial literacy over time simply through learning by doing.
So the behavior leads to the literacy, not the other way around.
It could, yeah. Rather than literacy being the initial cause of that behavior, so the causal arrow could point in the opposite direction or even in both directions.
Okay, let's unpack this. It's kind of like trying to figure out if healthier people run marathons or if running marathons makes people healthier. Could be both, right? But which direction is stronger? What's the primary driver? So how do researchers try to untangle this tricky web of causation to confidently say, yes, literacy causes better outcomes?
Well, it's tough, but they have some sophisticated tools. A common and powerful strategy to address these challenges is using something called instrumental variables, or IVs for short.
Instrumental variables, how do those work?
An IV is essentially a cleverly chosen variable. It needs to be strongly correlated with financial literacy itself, but crucially, it should only affect financial behavior through its influence on literacy. It shouldn't have any direct effect on behavior otherwise.
So it's like finding a specific nudge towards literacy.
Exactly. It's like finding a natural push towards greater literacy that doesn't directly affect financial outcomes in other ways. If you can find such an instrument, and finding a good one is hard, it helps isolate the causal effect of literacy, giving us much more confidence in the results than just looking at correlations.
So they're looking for a very specific, almost isolated cause and effect pathway. What kinds of clever instruments have researchers actually used to try and prove this causal link? This sounds like a bit of statistical detective work.
It absolutely is. And researchers have gotten quite creative. They often leverage what they call plausibly exogenous factors.
Meaning factors outside someone's control.
Precisely. Factors that are outside the individual's direct control or choice, which then affect their financial literacy. Some examples the paper mentions include past, non-voluntary exposure to mandated financial education in school or the workplace.
Like if your state required a class.
Exactly. If your state mandated a financial literacy course when you were in high school, that exposure wasn't your choice, but it plausibly increased your literacy and likely didn't affect your later financial behavior except through that increased literacy. Other examples include using the financial situation of an oldest sibling as a proxy for the family financial knowledge you might absorb, but which shouldn't directly influence your individual financial decisions other than through your own acquired knowledge. They've also looked at bank information policies, which might subtly push individuals to learn more, broader education policies, or even macroeconomic conditions that might incentivize or facilitate learning about finance. Another really creative instrument mentioned is the cost of learning financial knowledge, sometimes proxied by whether one's parents had an economics degree, based on the assumption this might make financial knowledge acquisition easier or cheaper for the child, influencing their literacy but not their later behavior directly.
Those are clever. So does this IV approach give us a clear answer?
Well, the paper states that while these sophisticated strategies provide compelling evidence of a causal effect of literacy on behavior, it also cautions readers to exercise some caution. The assumptions required for instrumental variables are very strong and can be difficult to fully prove definitively. However, these methods are currently the best available tools for trying to discern causality in observational data, and they definitely push us beyond just looking at simple correlations. They give us more confidence that literacy does matter causally, ###B, the impact on saving, investing, and wealth accumulation.
Okay, so with those important methodological caveats in mind, acknowledging the challenges, but also the clever ways researchers try to address them, what has the research consistently found? How does financial literacy actually shape our financial lives, especially when it comes to the crucial stuff like building wealth and securing our future?
Well, one of the canonical findings, as the paper calls it, meaning a widely accepted, really robust result found across a vast number of studies and many different countries, both advanced and emerging economies, is that financial literacy significantly affects retirement planning and savings behavior.
Planning and behavior.
Yes, both. It applies both to whether people save at all, which economists call the extensive margin, crossing that threshold from zero savings to having some savings, and also how much they save, which is the intensive margin, like increasing the amount you're already putting away each month. Numerous studies consistently confirm this strong link.
So basically, if you understand the basics of compounding and future value and all that, you're much more likely to start saving and to save more consistently for your long-term goals.
That seems to be the case, yes. It provides the foundation for making those future-oriented decisions.
So if you're more financially literate, you're not just planning more, you're actually putting more money aside. That intuitively makes a lot of sense. But does it also affect the quality of your savings? Can it help you get better returns, even on basic instruments, not just complex investments?
Absolutely. And this is a really key insight that goes beyond just saving more. The research shows that people with higher financial literacy tend to accumulate more wealth, not just by planning better and saving more diligently, but also, crucially, because they achieve better returns on their savings, even with relatively basic financial instruments.
How so?
For example, a 2018 study mentioned in the paper found that a 1 standard deviation increase in financial literacy was associated with earning a higher interest rate on savings accounts.
Just on regular savings accounts, not stocks or anything fancy?
Exactly. This wasn't about complex investments. The study suggested it was simply because individuals with higher literacy were more likely to use online bank accounts, which often offer more favorable conditions. It implies they searched more effectively, or they understood the value of even small differences in interest rates over time. They just make smarter, more informed choices about where to put their basic savings.
That's powerful. Small advantages adding up.
Precisely. Furthermore, there's robust evidence that financial literacy is positively associated with stock market participation, meaning more literate individuals are more likely to actually invest in stocks beyond just savings accounts. And when they did invest, they tend to have better portfolio diversification and ultimately achieve higher portfolio returns. They seem to make smarter investment choices that align better with their long-term goals and risk tolerance. The paper also highlights something interesting: positive externalities.
Meaning benefits spill over to others.
Yes. Your financial literacy can generate benefits beyond just yourself. For instance, it might influence family members or peers to also make better financial decisions, perhaps through conversations or shared knowledge. It can create a positive ripple effect in your social network.
So being financially savvy isn't just good for you. It might help those around you too. #TakeC. The impact on debt behavior, that's really clear for assets and building wealth. What about the other side of the financial coin debt? We often focus maybe too much on growing wealth, but managing debt, especially today with rising interest rates, is just as crucial, maybe even more so for many people. What does the research say there about the impact of financial literacy?
Yeah, that's a critical point. While it has been studied less extensively than asset accumulation, the research still shows significant effects of financial literacy on debt behavior too. Individuals with limited financial literacy, the studies find, tend to face higher costs of borrowing.
Meaning they pay more interest.
Effectively, yes. They might take on loans with higher interest rates or less favorable terms, maybe because they don't fully understand the fine print. Or perhaps they don't compare options as effectively across different lenders. They also report more concerns about excessive debt, seem to have difficulty assessing their debt situations accurately, and unfortunately are statistically more likely to carry debt into retirement.
And carrying debt into retirement can be really crippling.
Absolutely. It can severely impact financial security in those post-working years when income often drops. Studies also consistently show that positive correlation between financial literacy and the cost of borrowing, for example. A UK study found this quite clearly. And a really key finding from a 2013 study by Girardi and colleagues is that numerical ability, which is a core aspect of financial literacy, just basic comfort with numbers, is predictive of mortgage default.
Wow. So understanding the numbers can literally be the difference between keeping or losing your home.
That study suggests it's a significant predictor, yes. It really highlights the real-world, high-stakes consequences of lacking this fundamental numeracy aspect of financial literacy when dealing with complex long-term debt like a mortgage. #D NFCS 2021 data reinforces these patterns broadly across groups. And just to make sure these findings weren't just historical artifacts or specific to certain data sets, the researchers replicated many of these patterns using the most recent data available, that 2021 National Financial Capability Study, NFCS in the US. For their instrumental variable analysis, trying to get at causality, they used the financial education in school variable as their primary instrument for financial literacy.
Okay, relying on those state mandates again.
Exactly. Arguing it's plausibly exogenous because much of its variation stems from those state-level mandates rather than individual choice, as we discussed. And the strength of this instrument was confirmed in the data. The first stage, F statistic, which is a technical measure of how relevant the instrument is, was about 50, which is very strong. It showed that those exposed to financial education in school scored, on average, about 0.15 standard deviation units higher on the big three questions. So it meaningfully impacted literacy.
Okay, so the methodology seems sound, giving us more confidence in the causal claims they're making. What did these replicated results, using the very latest data, tell you about the impact of financial literacy on everyday financial behaviors?
Well, they found that both standard statistical regressions, which look at correlations, and the more rigorous instrumental variable estimations, which aim for causality, confirmed a strong positive relationship between financial literacy scores and outcomes such as retirement planning and the self-reported credit record.
So literacy leads to better future planning and better credit management.
That's what the evidence strongly suggests, yes. It reinforces that literacy helps with planning for the future and managing your credit effectively day to day, which is absolutely fundamental to overall financial health. Conversely, financial literacy was negatively correlated with financial fragility. That's measured by your confidence in being able to come up with $2,000 quickly for an emergency. Higher literacy meant less fragility.
So more peace of mind, essentially.
You could interpret it that way, yes. And it was also negatively correlated with reporting too much debt. People with higher literacy were less likely to feel overwhelmed by their debt. These are direct, measurable impacts on your daily financial well-being and your sense of security. It really moves beyond just abstract knowledge to showing real-life consequences and benefits.
Okay, that's compelling. Did the impact vary across different groups in this latest data?
That was a particularly important question they tested using the NFCS replication, the question of heterogeneous effects. They meticulously split the sample by gender, by college education status, and by minority status to see if the impact of financial literacy was perhaps stronger or weaker for certain groups. And the result. They found no evidence of heterogeneity, and the equality of coefficients cannot be rejected in any subgroups.
Wow. So the positive effects were consistent across the board.
That's what this analysis indicates, yes.
That's a really powerful takeaway for you, the listener. It means that the positive effects of financial literacy on your behaviors and outcomes seem to be broad and robust. They're not just limited to certain segments of the population. It really reinforces the idea that improving financial literacy has widespread benefits for pretty much everyone, regardless of their demographic background. It suggests it's truly a universal tool for financial empowerment. Tag 3. Can financial education make a difference? The evidence from programs. Okay, so we firmly established that financial literacy matters profoundly. It directly impacts financial behaviors, financial well-being across the board. The next logical, and I think maybe the most hopeful question for you is, can we actually teach it effectively? Can financial education programs actually work? Can they boost financial literacy levels and in turn genuinely improve financial outcomes?
Right.
Or is financial literacy just something you have to kind of pick up along the way through life experience?
Right. This is absolutely the critical next step. If literacy matters, can we improve it through education? This is where the literature has really shifted gears in recent years. Instead of just observing correlations between existing literacy levels and outcomes, researchers are now actively evaluating the causal effects of specific financial education programs themselves. The paper emphasizes a clear move away from relying solely on observational data, which, even with sophisticated statistical methods like 5E, can still be fraught with complications and sometimes lead to estimates that are inflated and not very precise.
So moving beyond just observing people.
Exactly. Instead, researchers are increasingly turning to experimental and quasi-experimental evaluations to get cleaner evidence. And the gold standard here, as the paper highlights, is randomized controlled trials, or RCTs.
The same kind used in medical research.
Precisely. They're considered the most rigorous method because random assignment of individuals, some get the educational program, some are in a control group that helps ensure that any observed differences in outcomes are truly due to the education itself, not some other confounding factor or pre-existing difference between the groups. The underlying premise is simple but powerful. If financial literacy is truly important and consequential for behavior, then well-designed education programs should be able to affect that behavior. RCTs are the best way we have to test that premise rigorously.
Okay, so RCTs are the gold standard. But before we dive into those highly controlled experiments, the paper also discusses something called natural policy experiments. These sound interesting, like real-world policy interventions that researchers can study. What have we learned from those, say, from high school financial education mandates here in the U.S.?
That's exactly right. These studies cleverly leverage variations in when and where certain policies, like state-level financial education mandates, were introduced. They use these real-world changes as a kind of natural experiment to identify the causal effects of that education. And the evidence from these mandate studies generally suggests long-term improvements in their financial literacy and behaviors for the students who were exposed to them.
What kind of improvements?
Specifically, these mandates have been found to increase financial literacy scores among the students later on. More importantly, they also seem to increase saving outcomes and reduce household debt for these individuals once they become adults. Furthermore, some studies find they boost credit scores and decrease default rates, not just on consumer loans, but crucially also on student loans, leading to higher repayment rates among those who went through mandated courses.
That's huge, especially given the student debt crisis.
It is. These mandates have also been linked to reduced use of alternative, often high-cost financial lending services like payday loans among young adults and increased bank account ownership among individuals with lower levels of education. And importantly, addressing a common concern, the paper notes that these mandates generally do not appear to cause adverse outcomes such as a reduction in high school graduation rates. So adding this to the curriculum doesn't seem to hurt other educational outcomes.
But is the evidence totally consistent?
Well, like most research areas, there are nuances. The paper does note that some studies do not report such broadly positive outcomes across the board, and others suggest that the mandates might have a larger effect on outcomes that are more immediate and relevant to students, like understanding credit cards or basic budgeting rather than very long-term, more abstract concepts like retirement planning, which might not resonate as much with a teenager. So the timing and relevance of the content might matter.
Okay, that makes sense. But still, overall, pretty positive findings from these real-world policy shifts operating at scale, showing tangible impacts on young people's financial lives down the road. What about beyond schools, say in the workplace? Have we seen similar successes there from natural experiments?
That's been a bit more of a mixed bag historically. Early workplace financial education programs often showed relatively small or muted effects.
Why was that?
Often because those early programs were quite limited, maybe just handing out brochures, holding a single brief seminar, or having information tables at a benefits fair, kind of light touch stuff. But the paper notes, more recent work in this area is more promising. This is likely because the programs being studied now are often more robust and more comprehensive than those earlier efforts.
Like actual courses or workshops.
Exactly. For example, one study looked at the staggered rollout of a more intensive financial education program in the U.S. Army. They found that the course actually reduced credit card balances and arrears and persistently increased retirement saving rates among the soldiers who took it. Similarly, another study in Denmark found that exposure to economics education in higher education had large effects on reducing subsequent loan defaults and arrears among students.
So more substantial education seems to yield better results.
That seems to be the pattern. And the great benefit of this whole natural experiment literature, whether it's school mandates or workplace programs, is their external validity.
Meaning they reflect the real world.
Yes. Because these programs are operated at scale, often as actual policies, the effects observed likely reflect the true impact of financial education in a real-world setting, not just in a controlled lab environment. This really complements the internal validity, the causal certainty we get from RCTs, giving us a more complete picture.
Okay, so if natural experiments provide strong, real-world evidence, RCTs, those randomized controlled trials, are considered the even better standard for really proving causation definitively. The paper talks about a massive increase in these rigorous studies recently, moving from just a handful a decade ago to dozens now. What's the collective wisdom from synthesizing all these numerous randomized trials? What do these gold standard studies tell us about whether financial education really works when put to the most rigorous test?
You're right. The number of rigorous RCTs evaluating financial education has indeed grown exponentially in recent years, which is fantastic for the field. The most recent and comprehensive meta-analysis cited in this paper, conducted by Kaiser and colleagues in 2022, was able to draw on as many as 76 RCTs. That provides a very robust and comprehensive picture by pooling results from many different studies.
76 RCTs. That's a lot of evidence. What are the main takeaways?
There are basically 4 key takeaways from these meta-analyses. First, and maybe most fundamentally, on average, financial education has a causal effect on financial literacy scores.
So it definitely teaches people the concepts.
Yes, this is direct proof that knowledge can be taught and absorbed effectively through these programs. The average intervention studied boosts financial literacy scores by about 15 to 20% of a standard deviation.
How significant is that in practical terms?
It's a pretty significant measurable gain in knowledge for participants. You can think of it as moving a good chunk of people up the knowledge curve, maybe from struggling to proficient on these basic concepts.
Okay, so it boosts knowledge. Does it change behavior? That's a crucial link.
Yes, takeaway number 2. Beyond just knowledge, these interventions cause changes in financial behaviors. The average effect is estimated to be about 6 to 10% of a standard deviation. And importantly, these results hold up even after researchers adjust for potential publication bias, the tendency for studies with positive results to be published more often. So we can be pretty confident that people don't just know more, they actually do things more effectively with their money after these programs.
That's great news. What's the third takeaway?
Third, and this is perhaps the most important insight from these meta-analyses for practical purposes. The effects of financial education are highly heterogeneous.
Heterogeneous meaning?
Meaning it's definitely not a one-size-fits-all solution. What works and how much it works varies considerably depending on the specific context of the program and the participants.
Okay. This is where it really gets compelling, isn't it? It's not a simple yes or no answer to whether financial education works. It's more about what specific types of education work, for whom, and under what conditions. That seems absolutely crucial for actually applying this research.
Precisely. The paper emphasizes that the results hinge critically on contextual features. The effects vary significantly by several key factors. For instance, they vary by outcome type. The meta-analyses find that treatment effects on budgeting and saving behavior tend to be much larger than effects on outcomes concerning debt behavior.
So it's easier to teach people to start budgeting or save more than it is to change deep-seated borrowing habits.
That seems to be the pattern, yes. It might be harder to undo existing debt patterns than to encourage new positive habits like saving. Effects also vary significantly by treatment intensity. The effect sizes increase with time spent in the classroom and are generally much smaller with light touch interventions such as mere information provision like those old brochures.
So more intensive programs work better.
Yes, and this actually contrasts with some earlier views that maybe classroom education wasn't that effective. The recent evidence, especially from these RCTs, shows that classroom-based programs are generally effective when they are substantial and well-delivered. More input leads to more output. And finally, effects vary by the age of participants. The meta-analyses find that treatment effects on financial literacy appear larger at younger ages, meaning kids and teens absorb the knowledge well, whereas treatment effects on behaviors are larger among adults.
Why that difference?
It suggests that while you can effectively teach concepts to young people, adults are perhaps more likely to immediately apply those concepts to change their behavior simply because they're already actively engaging with complex financial decisions like mortgages, investments, and retirement planning. The learning is more immediately relevant and applicable for them. So different strategies might be optimal for different age groups.
That makes sense. Okay, knowledge boost, behavior change, but highly variable effects. What's the fourth takeaway?
The fourth point, and this is incredibly promising, especially from a policy perspective, these interventions generally have low costs and therefore have a very favorable cost-to-effectiveness ratio. The paper states the average intervention costs about $60 per participant, with a median cost of only about $20 per participant. And for that relatively small investment, you get that average 1/5 of a standard deviation improvement in outcomes, combining literacy and behavior.
$20 to $60 for a measurable improvement.
That sounds pretty good. It's very good. The paper concludes this places financial education interventions favorably within the field of education interventions in general. It suggests it's a remarkably efficient way to achieve positive outcomes, yielding a potentially substantial return on investment for individuals and society.
So what does this all mean for you, the listener? It means that carefully designed financial education isn't just effective at changing financial knowledge and behavior, but it's also remarkably cost-efficient. That's a huge finding for anyone interested in policy, or even employers thinking about offering programs. The investment can yield significant returns.
Absolutely. And the meta-regression analysis they did digs even deeper into this heterogeneity, this variability, looking at specific study characteristics. It's shown in Table 4 of the paper.
What did that show? What drives the differences in effectiveness?
Well, it confirmed the importance of intensity. They found a clear positive correlation, about a plus 0.03% increase in the effect size for each additional hour of classroom exposure. This clearly reinforces that more time, more in-depth learning leads to more impact. It also quantified the delay or fade-out effect. They found about a Madigo 0.06% decrease in the standard deviation effect per week after the intervention ended.
So the effects wear off over time.
They can, especially for less intensive programs. This analysis suggests that the average effective interventions with less than 1 hour of total intensity fades out after about 4 years. This really highlights the critical importance of sustained higher intensity interventions if you want lasting effects, especially on persistent behaviors like saving. It's probably not a one and done solution. Reinforcement might be needed.
Right. What about who it's targeted at?
In terms of target group, they confirmed smaller effects for children relative to youth or adults. Likely because, as we discussed, behavior change is just harder to observe or measure at very early ages when children rarely interact directly with financial markets. Interestingly, they found no significant difference in effect sizes based on the average income level of the respondents in the studies.
And the type of behavior again.
And yes, confirming the earlier point on outcome type, the analysis showed effects on borrowing behavior are much more muted, only about 0.02 standard deviation units on average compared to the effects on saving behavior, which were much larger at 0.13 standard deviation units. It really underscores that encouraging positive savings habits appears more responsive to education than fundamentally altering existing debt patterns.
Okay, given all this powerful evidence about the effectiveness, the cost-effectiveness, but also the significant heterogeneity of financial education, what are the most reliable, actionable insights? If you were designing an effective program for you as an individual, or maybe advising on national strategies, what should we prioritize based on this research?
That's the key question. The paper pulls out some crucial insights, particularly emphasizing the distinction between short-term and long-term effects, especially when we look at large-scale school-based programs. This is vital for designing effective policies because sometimes the initial results can actually be misleading.
Misleading how? Can you give an example?
Sure. Let's look at a really large-scale RCT conducted in Brazil, studied by Bruin and colleagues initially in 2016, with a follow-up in 2022. This was a massive experiment involving over 25,000 16-year-old students across many schools. Now, in the short term, the program looked pretty good. It clearly improved financial literacy scores by about 1/4 of a standard deviation, and it had positive effects on various aspects of saving behavior. But surprisingly, it also showed some adverse short-term effects on borrowing. The students who got the education actually increased their use of expensive forms of credit, like high-interest store cards, apparently to finance consumption expenditures.
Wait, what? That's a powerful and honestly, potentially concerning initial result, isn't it? Increased literacy leading to more expensive debt, even just in the short term. That feels completely counterintuitive and frankly, a bit scary.
Yes, it certainly does seem counterintuitive at first glance, and this is a critical lesson from the research. Don't just look at the immediate aftermath, because here's where the long-term follow-up, which is so rare and so incredibly valuable in these kinds of studies, reveals the true story. The researchers were able to track down administrative data for about 16,000 of those students 9 years later, and they found a stark contrast to the short-term findings. 9 years on, the treated students were found to be less likely to engage in high-cost borrowing, and there were fewer arrears compared to the control group.
So the initial negative effect completely reversed.
It did. And they also found positive long-term effects on the probability of owning a micro-enterprise. This really highlights the critical importance of looking at both long-term and short-term effects. Initial adverse effects, like maybe experimenting poorly with newfound knowledge, can sometimes reverse over time as individuals mature and learn to apply their knowledge more wisely. Maybe they need that real-world experience, sometimes making mistakes, to fully integrate the lessons learned.
That's a crucial insight for evaluating programs. Patience is needed.
Definitely. And another similar large-scale program, this one in Peru, studied by Frisancho in 2023, also found immediate literacy impacts. When they followed up 3 years later, they found no effect on credit behavior, loan taking, at the extensive margin, meaning the educated students weren't necessarily taking out fewer loans overall. However, there were large effects on late payments at the intensive margin. The treated students had a reduction of arrears in the order of magnitude of about 20%.
So they still took out loans, but they managed them much better, avoiding costly mistakes like late fees.
Exactly. They seem to handle the debt they did take on more responsibly. So the policy implications from these two really large-scale, well-studied programs in Brazil and Peru are significant. They strongly suggest that financial education delivered in schools can make an important and lasting difference later in life, even if the short-term effects are mixed or take time to fully materialize. And given their limited costs, for instance, Frisancho reports the Peru program cost only about $5 per student. The paper argues pretty strongly that it seems warranted to advocate for personal financial education requirements in high schools. These positive long-term results from international RCTs also mirror the findings in the U.S. literature on mandates, which adds confidence that these large-scale school programs have good external validity. They seem to work reliably across different countries and contexts.
Okay, strong case for school-based education. Anything else surprising from these studies?
Yes, something fascinating and often overlooked: the evidence of positive spillover effects. The Brazil study found some positive spillovers onto the parents of the students who received the education. And the Peru study found some evidence of spillovers on parent financial behavior, particularly within households of lower socioeconomic status.
So teaching the kids can sometimes influence their parents' financial habits.
It seems so, yes. That knowledge might trickle up. And maybe even more critically, Frazancho's Peru study also found large effects on the financial literacy of the teachers themselves, about 0.3 standard deviations, and even positive effects on their savings at both the extensive and intensive margin. The teachers learned too.
Wow. So what does this all mean for you? The total welfare effects of school-based financial education might be even larger than we initially thought. They could benefit not just the students directly, but also potentially their families and even their teachers. That's a truly surprising fact, that a classroom program designed for kids could end up creating this positive ripple effect, improving the financial health of the adults around them, potentially boosting an entire community's financial capability. That really broadens the potential impact.
Right. Now, while school-based education is obviously a natural starting point for building foundational literacy, there's also been a significant wave of innovation in adult financial education recently. This came about partly because, as we mentioned, some of those earlier, more traditional classroom-based programs for adults often showed relatively muted impacts. That led researchers and practitioners to explore more dynamic and potentially more effective approaches for grown-ups who are already juggling complex financial lives.
So what kind of alternatives and innovations are proving more successful for adults? If you, the listener, are looking for effective financial education as an adult, what principles should you look for? What makes an adult program truly stick and make a difference?
Well, this new wave of RCTs evaluating adult programs has explored a really diverse range of more effective approaches that often move beyond just traditional lectures. Some key strategies include tailoring interventions very specifically to be highly relevant to particular target groups. Think about programs designed for migrant households or small business owners or people living in specific communities, addressing their unique financial challenges and goals directly.
Making it relevant.
Exactly. Also, simplification of the curriculum, often by introducing clear, easy-to-remember rules of thumb to make complex concepts more accessible, like, the save 10% of your income for retirement kind of guideline makes it less intimidating. Personalization is another key element, often including components like one-on-one counseling or coaching. This can address individual needs, specific questions, and unique challenges directly and confidentially, which might be hard in a group setting. Then there's the use of mass media campaigns leveraging television, radio, print, and increasingly social media to communicate financial information broadly and potentially change attitudes or norms around money management. The paper mentions a large pre-registered RCT currently underway in Italy that's evaluating exactly such a national media campaign.
Interesting. So reaching people where they already are. What else?
Other successful innovations include experiential learning. This means allowing participants to learn by doing, maybe through financial simulations, case studies, or real-world exercises. This hands-on approach can sometimes help de-bias people from common financial mistakes by letting them see the consequences in a safe environment. We're also seeing more digital delivery and gamification, using technology to make learning more accessible, self-paced, and engaging, sometimes making learning about finance feel almost like playing a game, which can boost motivation.
Yeah, making it less of a chore.
Right. Also, a shift towards active learning formats, moving away from passive lecture-based delivery towards more interactive group exercises, peer discussions, and problem-solving activities. A study from Uganda, for example, showed this active learning approach was particularly effective. And finally, an interesting approach is decentralized teaching, empowering local leaders, community health workers, or other trusted community members to deliver the financial education. This can increase trust, cultural relevance, and uptake by having familiar faces deliver the message within the community context.
So a lot of different innovative approaches proving effective. What's the common thread?
The summary, the bottom line for designing effective adult interventions seems pretty clear from the research and offers concrete guidance. They should be relevant to the life situation of those targeted. The content has to directly apply to their current financial challenges and goals. They should be accessible, entertaining, and actively engaging. People need to be able to easily get to them. They should ideally be enjoyable, not boring, and they must involve the learner directly. And finally, from a practical standpoint, they need to be scalable with moderate marginal cost per participant, ensuring they can be widely implemented and reach many people without prohibitive expense. It really boils down to meeting people where they are with content that truly resonates with their lives, delivered in a way that's engaging and easy to access.
Okay, so we have a much better handle now on what works in financial education and even how to design programs effectively for different groups. But the paper raises an even deeper, maybe more fundamental question. Why do these interventions actually work? What's the actual underlying mechanism that translates attending a workshop or taking a course into changed financial behavior down the line? Is it simply about acquiring more knowledge, like filling up a cup with facts and figures?
That's a fantastic question, and honestly, this area is still less well understood, which makes it really fascinating from a research perspective. The obvious candidate, as the paper puts it, is indeed a cognitive mechanism. The idea that improved financial knowledge simply leads people to correct their past mistakes because they now know better. You learn about compound interest on debt, so you try to pay it off faster. Makes sense.
Right, the straightforward knowledge pathway.
Exactly. And while some studies do provide evidence supporting such a mechanism, the paper notes that there remain unexplained direct effects. This means that even after researchers statistically account for the measured increase in financial knowledge, there's often still a behavioral shift that isn't fully explained just by that cognitive model. Something else seems to be going on.
So knowledge alone doesn't explain the whole effect.
It seems not always, or not fully. Surprisingly, some research, like a study by Horn and colleagues in 2020, found that lasting behavior changes among treated youth do not depend on persistent gains in financial knowledge. Their behavior changed long-term, even if their test scores on financial literacy faded somewhat over time. Similarly, another study by Kaiser and Menkoff in 2022 found that financial literacy scores didn't seem to fully mediate the observed treatment effects in an adult program that showed persistent impacts on behavior over 4 years.
Wait, that's really compelling. It suggests it's not just about what you consciously know or can recall on a test. Maybe something deeper is changing within the person, something beyond just remembering the facts.
That's exactly the implication, and it's a puzzle researchers are actively trying to solve. If it's not just knowledge driving the long-term change, then what else is truly going on? What's the secret sauce?
Yeah, what could it be? Self-discipline, confidence.
Those are definitely candidates. The paper mentions that measures of self-control do seem to have some explanatory power in some studies, meaning improved discipline might be part of the story. But even then, a large share of the effects often remain unexplained by these common mediators, like knowledge or self-control. More formal mediation analyses, which try to trace the causal pathways, though they come with strong assumptions, suggest something really interesting. They indicate that treatment effects are often not primarily mediated by increased financial numeracy, that core cognitive skill of understanding numbers and calculations. Instead, these analyses suggest the effects might be mediated more strongly by changes in things like financial awareness and especially attitudes.
Attitudes, like how you feel about money.
Exactly. It hints that the emotional and psychological aspects of money and decision-making, how you feel about saving, your confidence in managing finances, your general outlook and approach to financial matters, might be more critical drivers of long-term behavior change than initially thought, maybe even more so than just the cognitive knowledge itself.
It feels like a big shift in thinking.
It does, and perhaps the most exciting area of research related to this explores the malleability of preferences.
Meaning education can change our fundamental preferences.
Potentially, yes. Some studies have found that financial education programs seem to have causal effects on time preferences, like patience and time inconsistency, and the quality of intertemporal decision-making, especially for younger individuals. In simpler terms, this means that education might actually make you more patient, less prone to choosing immediate gratification over a larger long-term rewards, and better at making decisions that balance present needs with future goals.
So education could literally make you more patient.
That's what some cutting-edge research suggests. For example, a study with adults in Uganda showed causal effects of financial training on patience, as measured in incentivized economic games. And importantly, these changes in patience also carried over to predict actual saving behavior, particularly for the younger participants in the study. This suggests that financial education isn't just about filling a knowledge gap regarding financial products. It might be fundamentally reshaping core aspects of your decision-making psychology, like patience, building a foundation for better choices across the board.
So what does this all mean? It means financial education might be doing much more than we thought. It's not just filling a knowledge gap. It could be subtly reshaping our very preferences, like patience and self-control, which then drive different, more beneficial financial choices almost automatically. This is a really profound insight, I think. It opens up entirely new avenues for understanding human behavior and for designing even more impactful interventions that go way beyond just teaching financial facts and figures. It's about changing mindset and maybe even character.
Exactly. And building on that, the paper concludes by acknowledging the truly remarkable advance in research on financial literacy and education over the past 15 years or so. The field has come a long way, but it also very helpfully highlights three broad areas where more work is needed. This essentially provides a roadmap for future exploration, both for you as an interested individual trying to understand the frontiers, and certainly for researchers looking to push the boundaries of this important field.
Okay, so where should future research efforts be focused? What's the first big area?
The first area is digging even deeper into those causal mechanisms of financial literacy and education. We need a better understanding of a why and how.
Right, the fundamental questions we were just touching on. What kind of specific questions do researchers want to answer next about how financial literacy is formed and how education actually works its magic, particularly at that deeper, maybe psychological level?
Well, they want to understand the very roots of that persistent gender gap in financial literacy, especially why it emerges so early in life. What role does the social environment, family, peers, culture play in shaping financial literacy levels and subsequent behaviors? How exactly is financial knowledge, and maybe just as importantly, financial attitudes, transmitted across generations within families? And critically, how does heterogeneity, the variation in financial literacy, contribute to persistent inequality across generations? These are really fundamental questions about the generation and growth of financial literacy within different societies and groups.
Big picture questions. What about measurement?
Yes, refining measurement beyond just the big three is still important, trying to capture a broader range of relevant knowledge. The paper mentions the TIAA Institute GFLEC Personal Finance Index as one example of a more comprehensive measure being developed and used in the U.S. Researchers also want to better understand how financial literacy relates to individuals' mental models, their internal frameworks for understanding different aspects of financial markets. How does literacy shape your basic beliefs and expectations about how the economy works or how investments behave? That's another frontier.
And the link to preferences.
Absolutely. That link between financial literacy and economic preferences, like patience or risk tolerance, is a key area for future work. We know patient individuals appear more financially literate, but the field needs more studies exploring the detailed psychometric relationship among literacy, these preferences, and other aspects of human capital and decision-making. Are they jointly determined? Does one cause the other? And related to that, can financial education actually help to mitigate biases? We know financial literacy is negatively correlated with common cognitive biases, those mental shortcuts that often lead to financial errors like overconfidence or loss aversion. So can education actively de-bias individuals? Can it train us to recognize and overcome these common financial thinking traps? That's a really promising avenue for designing interventions that improve not just knowledge, but the quality of financial reasoning itself.
Okay, so deeper mechanisms is area one. What's the second broad priority?
The second area focuses on getting better data, specifically looking at long-term effects and overcoming survey data limitations. While we already have some high-quality evidence from RCTs that use relatively long-term administrative data, like those Brazil and Peru studies, the field needs even more research that relies on transaction data and other forms of administrative data.
Like actual bank records or credit reports, rather than just asking people what they did.
Exactly. This type of data helps avoid lingering concerns that the effects we see in surveys might be partly due to survey response behaviors. People reporting what they think they should be doing after an education program rather than reflecting their actual behavior. Or maybe just paying more attention because they're in a study. As digital finance continues to grow globally, this type of rich, real-world transaction data will become even more accessible and absolutely critical for validating findings with hard evidence of actual behavior change.
Makes sense. More real-world data. What's the third big research area?
The third broad priority highlighted is maybe the most conceptually challenging. Exploring the effect of financial education beyond simple directional changes in behavior.
Okay, this sounds really thought-provoking. The paper suggests we shouldn't just focus on whether people end up saving more or borrowing less, what does that mean for how we evaluate the true success and the overall impact of financial education?
It means shifting the focus more towards welfare assessments and the quality of decision-making, not just looking at simple directional changes in specific behaviors like saving rates. After all, the ultimate objective for an individual isn't just to mechanically save more or borrow less. It's presumably to increase their well-being or their overall utility, to feel more financially secure and achieve their personal life goals.
And sometimes the right decision might be complex.
Exactly. The paper points out that he may sometimes be optimal for consumers to do nothing, or even to take on debt strategically, depending on their specific goals, circumstances, and preferences. A good outcome isn't always more saving or less debt. This highlights the need for research approaches that evaluate the effects on heterogeneous consumers, people with different needs and goals within a solid theoretical framework of well-being, recognizing that optimal financial behavior varies greatly from person to person. So far, the paper notes, theoretical work on optimal behavior and empirical impact evaluations hadn't been as well connected as they could be.
A more nuanced view of success.
Precisely. And linked to this broader view, a critical unstudied area and a very complex one is looking at potential general equilibrium effects.
General equilibrium. What does that mean here?
It asks the question, if financial education becomes really widespread throughout a population, how will the financial industry itself react? It's not just about consumers changing, the market might change too. For example, could widespread literacy lead to financial institutions starting to discriminate more effectively between different consumer types, maybe offering better deals to the newly sophisticated consumers, while potentially charging naive consumers even higher prices?
Ooh, that's a concerning possibility.
It is. Or, conversely, could widespread literacy eventually lead to lower prices and better products for everyone due to increased competition and transparency as consumers become more informed shoppers and demand better value? We just don't know. The paper states there's currently no empirical work considering the equilibrium effects, which is a huge gap in understanding the full societal impact of rolling out financial education on a massive scale.
Fascinating. What else falls under this broader view?
The paper also calls for more research on spillover to untreated peers. How does knowledge and behavior change spread organically through social networks beyond the direct participants in a program? And more research is needed on the impact of consumer financial education on the supply side decisions of financial institutions themselves. How do banks, lenders, and investment firms actually change their product offerings, their marketing, or their pricing strategies when they know their customer base is becoming more financially savvy? Does the market itself adapt in beneficial or perhaps detrimental ways?
Right, the market response.
Exactly. And lastly, one more intriguing avenue mentioned is exploring the effect of financial education on our basic mental models of the economy and economic policy preferences. Other research has shown there's remarkable variation in how laypersons understand economic policy concepts. Could improving financial literacy also shape how people understand broader economic issues and maybe even influence their normative attitudes towards things like taxation, social security, or monetary policy? This could have profound implications for public discourse and democratic engagement, potentially fostering a more informed citizenry capable of participating more effectively in economic debates.
So moving beyond personal finance to civic understanding.
Potentially, yes. All these research priorities highlight that despite the really significant advancements we've seen, the field of financial literacy and education is still dynamic and evolving, with many exciting and important questions remaining to be answered. And the good news is new initiatives are emerging to support this work, like the global G53 network for researchers in this field and the new Journal of Financial Literacy and Wellbeing. These are being formed precisely to empower researchers to tackle these very questions and continue advancing our collective understanding.
That's great to hear. It feels like a field with real momentum. Hashtag tag outro. So as you reflect on this deep dive, we've really covered a vast landscape, haven't we? We learned that financial literacy, while absolutely fundamental to navigating our complex modern world, is surprisingly, maybe worryingly, low globally. And there are these notable, often compounding demographic divides. We then saw compelling evidence, using sophisticated methods, that financial literacy does indeed causally impact your ability to save more effectively, invest more wisely, and manage debt more responsibly. It really matters for your bottom line. And crucially, we discovered that well-designed financial education programs do work. They can boost both knowledge and behavior, especially when they are intensive enough, tailored to your specific needs and life situation, and delivered in an engaging way. And the benefits seem to be long-term, remarkably cost-effective, and can even extend far beyond you as an individual, potentially influencing your family and your broader community. Now, as you consider the profound impacts of financial literacy, here's a final provocative thought to mull over. If financial education can not only reshape individual financial futures, but also potentially influence deep-seated personal preferences like patience and self-control, as some of that cutting-edge research suggests, what might its widespread adoption truly mean for broader societal well-being? Could it fundamentally alter the dynamics of financial markets themselves, perhaps leading to a more equitable and transparent system? Could it even change how we collectively understand and engage with complex economic policy debates? And if so, what responsibility does that realization place on all of us, not just as individuals seeking to improve our own financial lives, but perhaps as a society looking to empower everyone with this vital knowledge and maybe even reshape our collective future? We hope this deep dive has provided you with a clearer, more nuanced understanding of this absolutely vital topic. Perhaps it sparked some new questions for you to explore, or maybe some important conversations to have with those around you. Thank you so much for joining us.